Good morning. Just now, I've just come off a Zoom meeting with a lender, and they're not a major banking lender. They're probably what you'd call a second or third tier lender, quite small, but they operate in a space which I'm guessing might become a bit more common as we go down the COVID path. And one of the things they do is they look at what they call non-conforming loans. Now, non-conforming loans sounds a bit daunting to a lot of people, but it can actually apply to many of us in a situation where you get yourselves into. And let me just explain what that might look like for you. It may well be that you're perhaps on a good income, you've done well over time financially with either PAYG or even self-employed, but you've racked up some personal debt. And he was giving a case where someone had about $95,000 of personal debt. Now, personal debt can be things like credit cards, personal loans, afterpay type services, things like that, where the debt's being ranked up. Now, in the situation where you have a property, an owner-occupied property or investment property, either will do, and you have some equity in that property. So let's say you've had a house for say 10 years. Your loan-to-value ratio or LVR is down to, let's say, 60% even. Could be lower. But below the 80% mark. And you have this personal debt that you've racked up because credit cards haven't been paid, or you've had a holiday and something's gone on and you've racked up the debt from the holiday. And you work out, particularly if you're paying credit card, that you're paying a fairly high interest rate for the privilege of having borrowed the money. These interest rates can be up to, as we all know, about 18% for credit cards. So this lender, they're not the cheapest in the market, but if you can imagine refinancing an 18% credit card debt down to somewhere in the realm of between 4.5% and 6.5%, that's probably the range of interest rates they operate in. That's a huge improvement in the amount you have to pay out the door in terms of cash flow each month. And it can mean the difference between getting on top of the issue and just continuing to have it there in the background. So I thought that was worthwhile mentioning that those sort of lenders are out there. There are probably quite a few now that are operating in that space, so it's getting a little bit competitive as well, so that's good. And like a lot of these lenders, they also deal with self-employeds. So people who have a self-employed business that they're operating themselves, and as opposed to personal debt, they may have got into a bit of a problem with ATO debt. So there's a bit of ATO debt that's built up, non-payment of GST, non-payment of the PAYG proportion of employee wages, or even unpaid superannuation, probably the three most common forms of debt which rack up that attract the ATO attention. And this debt, the ATO has been very lenient at the moment, particularly with the COVID situation, but these monies do need to be paid or repaid in due course. So what better way than to do it than to use some of the equity in your home at a very effective interest rate compared to even the ATO penalty rate, which is over 7%, and get this debt down. So look, they're just some examples of where these sort of lenders can help you out. Get you back on target with what you would like to achieve, and allow you to go forward again without the stress and pressure of having these debts that have to be paid each month at these high interest rates. Okay, that's all for now. Take care and cheers. Bye-bye.